Okay, hi everyone. Good morning again, and welcome to Saxo's weekly market outlook call, the Saxo Spotlight, as we call it. Today is Monday, April 17, 2023, and my name is Charu Chanana. I'm a market strategist with Saxo Singapore. I'll be taking you through today with what's happening in macro and markets, together with my colleague from Hong Kong, Redmond Wong. So let's get started. Taking a quick look at, I guess you can see my slides. So just here on your screens now should be a snapshot of the market performance last week, which was certainly a short week in many markets due to the Easter holiday on Monday. But still, we had quite a bit of key data, and we also had the start of a very key Q1 earnings season in the US. So here, as you can see, equities continued to bounce higher generally. But also, I think it's quite evident in this table that the theme of European outperformance has again, emerged last week. This is something we've spoken about extensively on this call earlier. It was obviously mainly propelled higher by the LVMH results and also a host of strong Chinese data in the week, which is kind of bringing the focus back on that China reopening story that has been quite slow to develop so far. But like I say, I think the expectations for H2 are building up again, and we'll hear more on that from Redmond later on. But besides that, we had a strong week for commodities generally. Oil prices closing higher once again. I think it was the fourth week in the row where oil prices closed higher. Copper and silver being very strong as well. FX was quite mixed, I would say. USD was pressured lower earlier in the week, although it reversed later on into the close on Friday. But the yield story was actually again stolen by European yields, which surged on continued hawkish commentary from the ECB and more signals of strength in the UK economy as well, coming from a point where we were expecting UK recession at the start of this year. So I think with that background in mind, let's do a quick macro roundup. So what's happening and what are Saxo's views going forward from here? So the key updates that we really got last week on the US economy were on the inflation side of the story. So on the headline CPI, we did have disinflation trends continue. In fact, headline CPI was down a full 1 percentage point. So from 6% in February, we came down to 5% in March. But the core was still firm. We also had PPI data, which again kind of confirmed disinflation trends, and that was both on the headline and the core, and markets were actually really cheering the negative prints in the headline and core PPI numbers, which we saw for the first time in this cycle. But I think also on the PPI side, then the February numbers were still revised higher. So again, I would say on the inflation side of the story, we have this broad disinflation theme continuing, but there is a lot of volatility, and it's not as straightforward to say that inflation is cooling and Fed's job is done. It's actually all over the place. We have some indicators which are certainly signaling that inflation has been quite sticky. And on Friday as well, we had the University of Michigan survey, which again showed that near-term inflation expectations were jumping higher. So I think it's just hard to draw any conclusions about inflation having softened enough and Fed having room to pause. So I've taken the snapshot here on the slide of the details of CPI. A lot of disinflation for March was driven by energy and by used cars. So these are categories which are pretty volatile, but services side still continued to signal stickiness as well. So as you can see from the breakdowns here. And then overall, if you read this data together with the NFP data that came out the previous week, we again are not at a point where we can say that the Fed's job is done. Looking into the second half of the year, we still see upside risks to inflation. Look at energy prices, crude oil prices. In fact, gasoline prices in the US at the pump are up 8% since the end of February. So that can obviously bring back some higher inflation prints going forward. And then, of course, look at the banking sector concerns as well. We had some data out on Friday which showed that commercial bank deposits and loans in the US are rising again. Deposit inflows for all types of banks, large, small, and foreign banks, and was up, and then lending was up as well. And we will get to hear from Redmond again on the bank earnings that came out on Friday. But overall, what we're seeing here is the banking crisis concerns have eased a little bit. So that can also obviously bring back demand pull inflation pressures in the second half of the year, again, with labor markets still remaining tight. So that's the inflation side of the story. Now let's look at the recession side of the story, which is where the big focus is now. So even if inflation concerns continue to rise from here, I don't think we're at a stage where we can expect a lot more Fed rate hikes. Certainly, we may or may not see a hike in May, but after that, it does seem like the Fed is entering a pause. So the bigger question for the markets really right now is, will the Fed really cut rates this year, and how soon can they start cutting rates? So right now, we do think that the markets are in this Goldilocks situation where the assumption is that inflation can continue to cool, and recession isn't looking as bad either. So this is a chart from JP Morgan here on your slides here. It is showing how corporate balance sheets have been quite strong, which basically means less dependence on debt. So the economy overall is less, prone to any kind of credit tightening concern. It's relatively more resilient. But anyway, from how the deposit and the loan data is also looking right now, concerns of a credit tightening itself are reducing. But even if one is going to happen because of the banking sector concerns we saw in March, that does not mean it's going to have the same level of impact on the economic growth as it did back in 2008. So like I said, the next big question that the markets are trying to find an answer to is, can the Fed really cut rates, and how soon can that happen? So I addressed that in an article on Friday as well, but just touching upon that quickly here. So current market expectations are pricing in one more rate hike from the Fed in May, and then some 200 basis points of rate cuts over the next 2 years. Now, given what I said earlier, that we see upside risk to inflation still in the second half of the year, my sense would be that the risk reward remains tilted towards a hawkish shift in Fed expectations, provided, of course, the bank stress does not materially deteriorate from here. So even if that inflation was to come back higher or does not cool as much as what is being expected, we obviously we're probably not going to be adding more rate hikes into the market expectations. But what we think is that the expectations of rate cuts this year is aggressive, and it needs to move out of this year or into the next year, or needs to get reduced at least. So I think that's the key thing to watch from here. For this week, we don't have a lot of data flow from the US. So what will be key will be the Fed speakers, especially as we get into the Fed's quiet period after this. So here's a list of all the Fed speakers that are going to be on the wires this week. The ones in bold are those that are specifically talking about policy. So I'll be tracking that closely, what they say, not just for the May meeting, but generally for the Fed path from here. What are their views on a recession to come and the Fed to cut rates? Remember, it was also comments from Fed member Waller on Friday that kind of put the markets in a reverse gear into the close, bringing dollar higher and landing and leading to kind of a crash in gold prices as well, back to 2000 levels. So he argued in favor of more monetary policy tightening. If we continue to get those kind of views from Fed speakers this week, we could be possibly prone to a hawkish shift in the market expectations of the Fed from here. Let me pause here now and pass over to you, Redmond, to discuss the key things that you're watching.
Thank you, Charu. And hope you can see my screen. I think here I saw mainly the bank earnings on results from last Friday. And for all, this is the three major banks, JP Morgan Chase, Citigroup, and Wells Fargo. And these three systematically important financial institutions announced the earnings and revenue. All three of them beat analyst estimate, and the results were pretty solid. And so especially you look at JP Morgan, and JP Morgan is seems they are getting deposits, and even for those non-interest bearing deposits, they are showing 1.2% quarter-on-quarter increase. So that that means they have a lot more pricing power, So while the smaller bank have to raise interest rates to try to keep the deposits and may not be able even to do so, and JP Morgan, the non-interest bearing deposit actually grow 1.3% quarter from quarter. So Citibank, Citigroup, the deposits is a little bit less good. That is down 3% quarter and quarter in Citibank. And all three of them, the good thing is all three of them say they have not been tightening lending standard. That's encouraging because it's one of the worry that in the market is the bank have to tighten lending standards as they have started to do so already in July and will also that will help push the economy into slow down or even a credit contraction induce a recession. But of course, the real test is really on the regional bank, which we will see some of the earnings. Uh, we will see that earnings next week, this week, starting seeing this week, and from Sions and from Scions, and then more coming on the week after for those earning results. And
Redmond, we can't hear you. I think we lost your sound.
hello, yeah, can you hear?
Oh, good now.
Yeah, okay, sorry. Yeah, and so have did you hear what I say about the bank?
Yeah, I think we just missed a line or two, not more than that. Yeah.
Oh, okay, I see. Okay, excellent. Thank you. And I think that overall is I think we need to focus on what the regional bank are reporting later this week, and also more will be actually the week after. So I think on this chart, and you can look at it, is JP Morgan definitely is the big winner among the banks, and the dark blue line is the share price of JP Morgan is that normalized from over the last 12 months. So it's up almost 8% over the last 12 months. And the very one at the bottom, the red line is the regional bank ETF, and that track the major regional bank in the US. And it was down significantly. You can see, and after the rather good results from the major bank last Friday, and the regional bank attempted to rebound, but actually it ended up is came down again on Friday. So there still is a stress there, and it's because of I think the deposit price from the smaller bank are still continuing, so they are still under pressure on profitability because they have to either higher interest rate or they have to reduce the business volume. So they have to cut down on their loan and investment as well. So let's move on a little bit on what we are watching on earnings, and we'll be seeing result from Bank of America, and also we say we'll be seeing some original bank. I will put it here with the Scions, and we'll be having it, and then of course it's very important. We'll be having a Tesla and on Wednesday, and also we will be having Netflix this week on Tuesday. And it's also interesting to look at the ASML's results, and given semiconductors is really hot, and we need to see how things going there. So on this chart, I just put a treasury yield for your reference, as Charu you already mentioned about now the market pricing in back in maybe a little bit of I mean fully priced in almost fully priced in a May hike, and also maybe some possibility for June hike. So yield has picked up a bit, and we still assess those who think that it's still worthwhile to have some short dated treasury in the portfolio. So it's about 4%. Investors, if they have interest they can still pick if the yield bounce from here. It still may be a good time to accumulate some. Um, So back to this part of the world, China, and China exports. I mean, one bright spot last week was from China is the exports is while most of the economists surveyed expecting a decline in export, but actually the number came out in US dollar term. Exports in China grow more than 14% in March, and so that was one of the because there has been worry in the market that for in 2023, given the geopolitical tension, given the slowdown in in the global economy, and also the reshoring trend, some of the manufacturing capacity moving away from China, and that would be quite difficult, would be quite a headwind in the China export. But the number for March was encouraging and better than expected. And this week we have tomorrow we have GDP, industrial production, retail sales, and fixed asset investment coming out from China. And according to survey, retail sales expecting to grow 8% year on year in March, and a big jump from the 3.5 level over the past 2 months. And industrial production is expecting to rise 4.7% year on year. And GDP and now the consensus is calling for a 3.9% year on year increase in the first quarter. So some of those high frequency data just came out late last week. It's like electricity consumption. I think that is a very good indication for industrial production, and for the secondary industry, mainly manufacturing, and the electricity consumption is rose 14% year on year. Overall, for the whole country, for all sectors, is up 5.9% year on year in March. So, but for secondary industry, according to statistics, up 14% year on year. That was pretty quite strong. And the household sector consumption of electricity came down a bit. That may be a good thing, because that means people going out more this March than 12 months ago, and because of the reopening. So there is some kind of a high frequency data supporting a stronger estimate and forecast for the number coming up in the next few days from China. And I think I stop here and pass it back to you, Charu.
Thank you, Redmond. So, just wrapping up with a quick chart on FX and commodities as well. So, this chart on the left here shows the weekly performance for key FX pairs. So, like I said earlier, it was a tough week for US dollar because inflation prints confirmed a softening trend overall, very broadly speaking. And as long as we are in this Goldilocks expectations of cooling inflation, modest growth, it will probably remain hard to turn around that USD downtrend. One of these assumptions really of Goldilocks have to take a turn for the worse for USD strength to return. Either you see yields running much higher because of inflation fears, or you see recession concerns deepening aggressively, and that's when USD strength could potentially come back into the picture. So last week we actually broke some key levels. In euro dollar we went above 110, and in sterling dollar we went above 125 as well, before a reversal late on Friday, and then this morning as well. These pairs are a little bit softer to start off the week, but I think a sense here is that euro dollar certainly looks like potentially there is more room on the upside because of the simple, policy divergence story that's playing out, where the Fed is expected to pause, but ECB could continue to tighten. There's expectations of about 75 basis points of additional rate hikes from the ECB, and the members continue to, send out a very broad hawkish commentary from the ECB. For sterling, this week is really key because we need to obviously test whether this 11th May meeting that we have for the Bank of England could see another rate hike or not. And we have, so far economic indicators have surprised on the upside, but expectations for next week's data isn't looking as great. So we may be at the cusp of seeing that sterling strength reverse somewhat in the coming week. I think that's something to keep on your radars. And elsewhere, the Japanese yen certainly again remaining quite vulnerable to those higher yields that we've seen last week, and potentially going to still remain volatile because of the volatility in the rates expectations, but also because of the expectations from the Bank of Japan, where the new governor, Kazuo Ueda, would be chairing his first meeting at the end of this month. So we do have Japan CPI due this week on Friday, and I think again potentially another source of volatility there for the Japanese yen. On the commodity space, I will be particularly watching gold and oil this week. Gold because it came back lower to the key 2000 level, especially as I said earlier, Fed commentary will be key this week, and that obviously means gold prices. They usually react a lot to that, to the expected Fed path as well. So maybe we could continue to see a correction in gold, especially if we continue to see those hawkish comments coming from Fed members again. So I think the key supports at 1992 and 1988 for gold. These will need to really hold for that upside momentum to continue. On the oil side, like I said, we've had 4 consecutive weeks of gains, mainly due to the focus being on supply worries, and we approached key resistance area of $87. It's a heavy resistance there. And again, if hawkish rhetoric is maintained this week, demand concerns could come back, which could create some pressures on oil prices. And I think that's a wrap from us today. I hope you enjoyed this, and thank you for joining us from Redmond and myself. Have a safe week ahead.
Thank you.
Bye.